Hi, I'm Matt Lewis from Techview Wealth Advisors, and today we're taking a look at what makes a good 401k. Before we get started, we have this disclaimer, which I highly recommend. I love this disclaimer, but I have read it many times, so I'm moving on. All right, so 5 criteria we're looking at to figure out how good your 401k is, the first of which is the most important, the size and the terms of the company contribution. Then we'll look at how quickly you get possession of that contribution through vesting. We'd like to see a Roth feature. We'll be looking at the mega backdoor Roth mechanism. And then finally, we're going to look at the breadth of investments that are possible within your plan. Let's do a quick review of the different kinds of contributions that go into a 401k plan. There are 3 of them. The first bucket consists of employee contributions that can be pre-tax. So if they're pre-tax, you're going to lower your income and lower your taxes now. And that's why the IRS sets a limit on these. In 2022, that limit was $20,500. The second bucket is for company contributions. These will vary from company to company based upon their formula. And a bit of trivia, these contributions are always pre-tax. In bucket number 3, we again have employee contributions, but this time they absolutely must be after tax. If we take the contributions from all 3 sources, all 3 buckets, they can total no more than $61,000 in 2022. The IRS updates this figure regularly. And if you are 50 years or older, the number is bumped up by $6,500 in the bottom box, and that takes the aggregate up to $67,500 in 2022. Now let's look at some examples of company matches from the real world. We're going to make some assumptions. Our employee is making $100,000 in salary, is in year 2 of employment, and is going to make contributions just large enough to get the full company match. I'm not saying that's the best strategy to prepare for retirement, but it does make comparing numbers a lot easier. The average 401k out there is offering a match of 50% of employee contributions up to 6% of base salary. So in our case, the average would be a contribution from us of $6,000 as the employee, and from the company, $3,000. Now let's look at some real world examples. Up first, we have Citigroup. Citigroup will match 100% of employee contributions up to 6% of base salary. So we contribute $6,000 and so does the company. One fly in the ointment, you'll see a little asterisk down there. If you can see that font, it says that the employee must work for a year before participating in the 401k. So no immediate eligibility. Not great. We'd like to see definitely immediate eligibility in a 401k plan. Next, we have Southwest. Southwest will make a match of 100% as well, but not on 6%, but on 9.3% of base salary contributed by the employee. So we would contribute $9,300 and the company matches that dollar for dollar. Next, we have Farmers. Farmers is getting interesting because they have what we call a non-elective contribution. That is, Farmers will contribute 4% of our base salary whether or not we choose to participate in the 401k. So that's $4,000 in before we've done anything. Then there's a company match of 100% on employee contributions up to 6% of base salary. So we put in 6, they put in 6, plus the 4 they've already put in. And last but not least, we have Duke University, which is making a non-elective contribution. That is, we as an employee don't have to put anything in when we will automatically receive a contribution from Duke of 8.9% of the first $72,000 of our salary. And then above that, the university will give us 13.2% of up to the next $233,000 of salary. I don't know if anybody makes that much money at Duke University, but in our case, we are an employee making $100,000 in base salary. So we can expect from Duke in our 401k plan a little bit over $10,000. Very generous indeed. So when you're trying to figure out these formulas, here's some advice. First of all, the first question you should ask is, how large is the match? Is it 100% or is it a partial match? Next, how is that match connected to our contribution, and how is that employee contribution defined? Is it a percentage of our base salary, or is it an absolute dollar amount? Obviously, we want to see a 401k that has conditions that are better than the average being a 50% match on the employee contributions up to 6% of base salary. But I think it would behoove you to look at the 401k plans of industry peers and compare their terms to your 401k terms. That'll be much more informative to figure out how good your 401k plan is. Up next, we have vesting of company contributions. Let's look at an example. Let's say we have an employee working for a company where vesting of company contributions is going to take place in year 3, and there is a match from the company of 50% on the employee contributions up to $20,500. You may remember that number as the limit on pre-tax contributions set by the IRS. So in year 1 and year 2, the employee contributes $20,500 each year. Then the company contributes 50% of that. Looks nice so far, but then the employee decides to leave at the end of year 2, and what happens? Those contributions are forfeited, they're up in smoke, and we are left with much less than we had expected. We had thought there was $61,500 plus investment earnings in our 401k. We leave the company with just 2/3 of that. So in your 401k, look for immediate vesting. We do not want to risk losing any contributions from our company should we leave or should we be asked to leave. Now let's look at the Roth feature of the 401k plan. If you have a Roth, it's going to take place in this lower box. The contributions would be after tax here. You may remember this box was what we had reserved for pre-tax contributions, and the IRS places a limit in 2022. That limit was $20,500 for pre-tax contributions that are deductible against your income. Now, why would you want to contribute after tax and increase your taxes currently? One reason is that the $20,500 limit applies to both pre-tax and after tax. So if you contribute after tax, you will end up with more money in retirement because those contributions and investment earnings are never taxed again if you follow the rules. Now let's look at company contributions and make our way up to the Mega Backdoor Roth, which would occur in this upper box if you have this feature in your 401k. So this is another great way to benefit from the features of a Roth and to avoid paying taxes on your investment earnings. In this particular box, you will want to make after-tax contributions and immediately convert them to Roth using the Mega Backdoor Roth before you make any investments, because if you get it backwards and you make the investments before you convert, you are likely to pay taxes on any gains that occur before the conversion, and who needs that headache? So remember, convert first, then turn the cash into investments. All right, so on this particular slide, we have $61,000 in aggregate contributions. Unless you're age 50 or older, you can go up to $67,500. Now, the last of our 5 criteria today, investment selection or investment breadth. In the beginning, when 401ks came out in the 80s, things were simple. We had balanced funds. You may know them as 60% stocks, 40% bond. That would be a typical balanced fund. Then things got more sophisticated with target date funds, in which investments are initially higher return, higher risk for younger employees, and then they pare back on both as the employee approaches retirement, become more conservative. And more recently, we see self-directed brokerage accounts that allow for a much greater selection of mutual funds, ETFs, and maybe even individual securities. So in some cases, you could manage your self-directed brokerage account just like you would a retail account. And this creates much greater opportunities. You can even get your financial advisor involved to manage the account and provide more holistic wealth planning. As you move from left to right, you have an opportunity for greater customization, and you also have greater complexity and perhaps more risks, so we need to be cognizant of that. In general, we want to see self-directed brokerage accounts with greater choice and the ability to buy and sell individual securities. All right, let's bring it all together. What makes a great 401k? First of all, it's a large and generous employer contribution. We want to see a full match, 100%. We want more dollars in our 401k coming from our company than its peers provide in their 401k plans. We'd like immediate eligibility in the plan. And if possible, we would like a non-elective contribution, meaning the company's going to put money regardless of whether we do. As for vesting, we want it to be immediate. We don't want to run the risk of losing company contributions to our plan. We'd really like to see a Roth feature, a mega backdoor Roth feature. And finally, as far as investment selection goes, we want to see a self-directed brokerage account that allows us to buy and sell individual securities. This allows us much greater customization, and we can get our financial advisor involved to provide holistic wealth planning. And that's our presentation on what makes a great 401k. I am Matt Lewis with Techview Wealth Advisors. I hope you found this informative and mildly entertaining. If you have any questions or feedback, get in touch with me by email. Or if you'd like to have a conversation, get acquainted, work through some issues, I've got a Calendly link here to the right. Set up an appointment with me. I would love to hear from you. Thanks.